A very good morning, everyone. We continue with our series on basics of financial risk management. This is Professor Shyam from LJ Integrated MBA 5-year program, LJK University, Ahmedabad. In the last lecture or in the last video, we saw the types of risk that an individual or an institution faces in general. And in that types of risk, we saw pure risk and speculative risk. We move forward and classify various pure risk. Right? We recall that pure risk are those risks which can result into loss or no loss situations. Right? The simplest example over here is once again that if I am traveling from Ahmedabad to Vadodara, I might face an accident or I might not face an accident. What we need to be sure about is there is no inherent gain in the entire situation. If I face an accident, I may have to pay for the damage to the car or the damage to my physical health. If I do not face any accident, that's fine. There is no gain. Say, for example, to just recall that I have a term insurance for 1 year and I have paid rupees 5,000 as premium. If something unfortunate does not happen with me in the time period of 1 year, that's fine. This is not a loss for me. But what we need to be sure is that we cannot claim back the insurance premium paid to the insurance company just because something unfortunate has not happened to me. So we need to be vigilant over here that pure risk are those where there is a situation of loss or no loss. There is no inherent gain in the entire situation. We can classify pure risk into 3 types of risk. The first one is personal risk. The second one is liability risk. And the third one is property risk. Personal risk are those which hamper an individual's capability to earn income. Examples are premature death, a family member, a sole bread earner, or a single earning person of the family may die because of any situation or any unfortunate event. The second one is as we age and as we move forward with our age, we might lose our capability to work at the same pace. Retirement or old age results into an situation where we cannot earn the same amount of money or we cannot work at the same pace that we used to do. If someone faces sickness or disability, whether it is permanent or temporary, this also results into and hamper, or this results into hampering of an individual's capability to earn. A person might face an accident where his limbs are cut off, his physical body is damaged, or there can also be an instance where unemployment has been there in the economy, right? Because of unemployment or because of any other social economic factors, it may result into a permanent hamper in income earning capacity of an individual, right? So what happened in COVID can also be considered over here because of any unforeseen circumstances. People were losing jobs. Migrant laborers were walking back to their native homes just because they were not able to find a solution of their employment. So these are the various types of personal risk. We now come forward to liability risk. Liability risk are those which arise from intentional or unintentional damage to someone or someone's property. It usually arises or it usually has its origins from law, right? So if I damage someone else's property, right, I might have to pay for the damages of the property that I have damaged. It can also be that where a liability of an employer may be fixed under workmen compensation law or any other labor laws that are applicable in India. Liability risk can also emerge from non-performance of any obligation or any uh, promised activity. Say, for example, that one is constructing a road. If the road is of substandard quality, you might have to repair it again or you might have to rebuild it again. That is what liability risk is all about. We now move forward to property risk. Property risk is another form of liability risk where we are physically damaging the property, right? These are the risks to the person in possession of the property being damaged, right? Immovable property, so assets like land or real estate can be the best example of property risk, which can get damaged due to flood, earthquake, fire, or any other natural calamity. One thing to note over here is the property risk can be direct or indirect or consequential. A direct loss implies that there is visible financial loss to the property. If an earthquake occurs and the building suffers huge cracks, which makes it unlivable, then it is a direct loss. Indirect losses are ones which arise from occurrence of an unfortunate incident, which results into a permanent or temporary destruction of the property. The best example is the loss of crops due to a flood is direct loss because we will lose the entire crop. But the loss to the land or its cultivation power is consequential one. The earthquake might damage the property. That is also an example of property risk. So that's it for the day. We will meet again in the next series of videos and we will continue forward with the basics of financial risk management. See you. Have a nice day.